Welcome to the Monday Futures Market Outlook for October 10th, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. We just bearishly crossed below this 80-week moving average about 2-3 months ago and remain below there. Now, what we'll see on the daily charts is that some sort of a short-term bottom has actually come in, but even if that leads to a multi-month rally, if so long as the market remains below this 80-week moving average or returns back below it, there could still be further weakness into 2012. So we'll be watching how the market reacts at these levels over here. Just to make some key intermarket observations, we have seen some sort of a turning point in the markets in the last week or more. Essentially, we've seen some tops in the on the short term for the U.S. dollar, as well as on the 30-year Treasury bonds. In the same regard, we've also seen some sort of bottoms in the stocks and in the commodity prices, as we've seen some recovery along the way. That's it's not a guarantee. It's probable we have seen the swing low bottom for the year, and only an unexpected catalyst would shift this. More than likely, we're going to work our way higher in maybe up to, let's say, the 1250 area on the S&P, and work maybe up to $90 crude oil and a few other upside targets as the market kind of unwinds this oversold state. Depending on the degree of the rally and how far it goes, 2012 can still have some negative implications, but if, at least for the remainder of this year, we are starting to become optimistic that the worst is behind it for 2011. When we take a look at that S&P 500 on the daily charts, we were talking about that wedge and subsequent breakdown. Now, we were looking at scenarios where the market could have had a substantial meltdown, but really the bulls did a very good job of containing the selling to a double bottom retest, and subsequently the market has done a pretty good job recovering off that. We now have a double bottom formation developing here. While it's not confirmed yet with a break of a neckline, the length and the size of the subsequent rally that occurred afterwards is at least giving some very positive signs that some sort of a short-term trading bottom is in. It would take some sort of substantial news catalyst to really reverse what's just happened in the last week. Really, at this stage, beyond there being a nice little short-term pullback, maybe to 1160, 1150 on the downside, there probably will be a solid push going into November up into the even as high as 1250, 1260 on the upside to retest all of that what was previously support, and now will probably act as overhead resistance. That would probably set up for what will be the next major trades into 2012. But right now, let's just see whether this market can complete this move higher. Next year, I want to take a look at that US dollar index, and we were looking for that rise higher to come up toward this 80 level on that dollar index. We're now seeing little reversals coming off of there. More than likely, we've seen some levels where the dollar index will probably see the high end of its range. I mean, could there be a scenario where the dollar index still spikes to 81 and then reverses back down? We certainly could, but really at this stage, more than likely the dollar index is going to consolidate in these levels to find its new level up at these higher zones. So I probably at this stage, while I'm not negative on the dollar index, I certainly think that it probably has seen some sort of a significant short-term high up on the upside. Next year, when we take a look at copper futures, copper has made it all the way down to that 320 focal point below and bounced. Really at this stage, a retracement up even to 350 to 370, even if it has this substantial strength even up to the 380, 390 level. We certainly could see pushes that way. Overall, there is still risk that that is just going to be some sort of a flagging formation that will still have to have copper retest its lows at some stage, but we probably have seen some sort of key support line developing up down around that $3 level. When we take a look at gold futures, gold has now seen some sort of a swing low as well. We're now seeing what could be a flagging or wedging formation higher that could still theoretically see gold still come back for a retest in the lows. But right now, gold probably should make it all the way up to 1700, if not towards 1750 on the upside, and it may even work its way higher like that over several weeks as it kind of makes up some of that ground, and then subsequently could potentially see reversals or rollovers later in the year. But right now it does look like gold will strengthen, at least on the short term. When we take a look at crude oil, we were drawing that wedge, and now crude has really just come for a double bottom retest, and just like the S&P 500 has made some substantial ground on recovering up toward this $85 area. Really at this stage, I think that while it's a little bit on the short term overbought, maybe a little pullback to 83 or $82 could happen easily. More than likely, crude oil will work its way up to the $92 area on the overhead resistance in the upcoming weeks. So watch for short-term pullbacks to potentially be buying opportunities in crude. When we take a look at that 30-year Treasury bond, we can see a little double top that developed now on that retest. We now have a break of that neckline. The selling has already been substantial, but really at this stage, more than likely on the short term, any little rallies on the Treasury bonds will probably lead to new shorting opportunities for probably a move all the way down towards the 134, 135 handle down below. And so I think the initial course has been run for Treasury bonds. Well, they'll need to find a lower end support. There's certainly nothing stopping over the next 6 months for Treasury bonds to push back to those previous highs. So we don't want to become overly bearish, but at least over the next few weeks, there's still room for Treasury bonds to continue to deteriorate down towards the 134, 135 area on the downside. That was your Monday Futures Market Outlook. Thank you for joining me.